Since it is such a important concept, I wanted to talk about market efficiency one more time, what it means, what it implies about information, and what it implies about investment strategies. There is a reading associated with this module. Reading 2, Efficient Capital Markets. It's from the Library of Economics and Liberty. There you see its web link, and it is also linked to on our website under our online modules as Reading 2. Efficient Markets deals a lot of what the assumptions are behind information. And here we have two types, private information and public information. Private information is something that an individual may hold that the market doesn't know. It may have value in that there may be investment strategies that could be built on that. An example of that might be if you are a high-ranking official in one of the publicly traded corporations. You know information about that corporation that the market does not know, and you could use that information to trade against or for or trade that company's stock and make money on it. That happens to be illegal, and that would be insider trading. Whether or not that is a big problem depends upon your view, but that is one example of private information, insider trading. Public information is assumed to be known to everybody and captured in the price, because if everybody knows it, they do their calculations and whatnot and incorporate that information into the market price. There are different forms of price efficiency. Weak would be that prices reflect all public information. Semi-strong, and this is actually what most studies would suggest the stock market is. It's semi-strong. Prices reflect all public information, and as new information becomes available, the prices will instantaneously adjust to that new information. That information will be built in automatically, quickly. This may seem not obvious at first, but if you ever watch markets and look at and see what happens with new information, they react quickly to that information. Strong says that all information, public and private, is already reflected in the market. Whether or not that is the case is a good question. But for our cases, we assume semi-strong price efficiency. Semi-strong price efficiency implies that there's no information in previous prices. We can't use charts or look at old prices to say anything about the direction of the market. That will specifically mean we will not find trends, or we will not find time dependencies. A couple of things we looked at in a couple weeks ago. And what that will mean in the end is that prices will be random from one day to the next. There is a famous book called A Random Walk Down Wall Street. It was written for a lay audience. It's still available. I would suggest, we aren't going to read it for this class, but I would suggest that you read it. It's a very good read. Um, and it talks about random prices resulting from price efficiency and then what that would imply for investment strategies. What market efficiency would imply is that you would in general follow a passive strategy. You would not be, for example, in and out of the market because you can't anticipate what the market returns are going to do based on past prices. You would be not in stock picking because the market already reflects all that information. You would tend to hold index funds because you would want to get the market return, and you would also try and keep cost of investing low. There's no reason to invest a lot in cost in investing because there's no market returns to be gained there. I mean, you can go with stocks that match your risk profile and be quite happy with the results because, or not, maybe not happy as they turn out, but there is nothing to be gained by trying to outguess the market. Note what efficient markets don't say. It doesn't say anything about the distribution of stocks within your fund. You could, or between stocks and bonds within your fund, because that would be um, influenced by your risk profile. Also, bond funds may not be efficient while stock funds may. And it doesn't say anything about risk preferences, so you would still want to match your risk preferences with your stock choices.